Hello and welcome to Sprott Radio. I'm your host, Ed Coyne, Senior Managing Partner at Sprott. I'm pleased to welcome Peter Krauth, author of the best-selling book, The Great Silver Bull, and editor of the only silver-focused investment newsletters, The Silver Stock Investor and The Silver Advisor. Peter, thank you for joining me today on Sprott Radio.
Ed, it's a pleasure to be here with you. I'm looking forward to our conversation.
Yeah, same. Well, as a new guest to Sprott Radio, it might be helpful for our listeners to hear a bit about you and then shift gears maybe and talk about why you decided to focus on silver. But let's start with you first. Tell us a bit more about you and your background.
I have been interested and invested in especially resources going back about 20 years, just sort of first on a personal basis and discovered early on, I guess. So yeah, about 20 years ago, discovered the advantages and the upside, I think, generationally, frankly, in the precious metals. That got me very interested, continued to do sort of more research on my own, and then eventually had the opportunity to work in research and write a resource newsletter, and did that for about 10 years with a group out of the US. And then for a couple of years did some freelance writing for mining companies. And then about 5 years ago connected with Gwen Preston, who had her own resource newsletter out of Vancouver. And we hit it off, teamed up, and launched a silver focused newsletter, and that would have been in January of 2021. So a
Okay.
little early, but definitely gave me the chance to be there before things developed.
Speaking of the newsletter, I noticed you have the two separate ones, and I don't want to guess on what the differences are. Maybe talk a bit about the silver stock investor versus the silver advisor. How do you think about those two?
Sure. So Silver Stock Investor is the one that I launched initially back in January of 2021. This is a subscriber supported or subscriber based newsletter. It has been from the beginning, and it really covers the entire silver space, everything from some larger ETFs, including certainly several Sprott ETFs, just as a full disclosure there, and through everything large royalty companies, large producers, and then everything from there all the way down. You've got your mid-sized producers, you've got some developers, some junior producers, and then some junior explorers, and then some pre-discovery companies as well. So I really cover the entire silver space on the equity side. The other newsletter is Silver Advisor, which I started back in January of this year. And that is a sponsor based newsletter. So the companies that we cover in that letter are sponsored by them, and it allows us to bring newsletter quality coverage for free to our subscribers for that letter.
Oh, cool.
So subscribers have access for free, and really the formula there is we will look at all material press releases from silver mining equities. We will review them, summarize them, and comment on them same day and get our comments out that day, so that if subscribers want for some reason to react on our interpretation of that news, they have some time to do so before the markets close. So that's really the business model there.
Great. And when you're looking at silver, do you draw a distinction between the physical market and then the miners themselves? And if so, how should investors think about that?
So yes, absolutely. I mean, the physical silver is the foundation. And if someone, asks me how should I get started, I'll always tell them if you have no exposure to this sector, I suggest that you buy some physical silver, even if it's a matter of a few, Canadian maple leafs or a few silver eagles. Pick them up, handle them, feel what it's like to have that in your hands.
Hmm.
It's a very dense metal. It's almost magical, frankly. You hear about these things when you read silver coins, gold coins, and until you actually have one in your hands, you can't. I don't think you can really appreciate what it's really like. So again, that's the foundation, the physical. It's the sort of the lowest risk in the silver sector. So yes, I do treat them separately, but both part of a fully exposed silver portfolio. Silver is quite a narrow space, a narrow sector, and getting narrower with mergers and acquisitions. I really think that it makes sense to cover the entire space. And as I say, everything from anyone who hasn't gained exposure yet, I feel things like mining equity ETFs are a great way to get your feet wet. You can buy that, you're instantly diversified. And then when you become more comfortable with that and you do a bit more research, then you can start to look at individual names. Silver is a more volatile metal. The equities tend to follow that as well, but you don't have to go to sort of the high end risk of the spectrum to have some exposure and have the potential for some really outsized gains.
You said something that really kind of caught my attention. I wrote it down. Generational upside is what I think you said. And I haven't really heard anyone say it that way before. And let's talk about that, because you have a lot of really great charts that we're going to unpack here today. But talk about some of that upside you're seeing, where we are today, and where we may be headed.
I almost don't know where to start. There really is so much to say. And I'm not the expert in this in terms when it comes to technical analysis and charting, but I do some and I follow that. And silver's been called one of, if not the biggest technical breakout of all time, at least in sort of in modern history, as far as assets go. And the reason for that is because it has taken 45 years for silver to better its 1980 price. Until recently, when silver did take out for an extended period, matter of days, weeks, take out the $50 level, silver was the only metal that had not surpassed its 1980 high. All the base metals, all the platinum group metals, gold, everything else is much higher than it was in 1980. If you adjust its price for inflation using official inflation, if you do that, just from rough memory, if you look back at the 2011 peak at just under $50, you'd have to be somewhere around $70, I believe, right now. And again, with the official inflation numbers, if you look at the 1980 peak, you'd be somewhere closer to about $200. I also saw a fantastic chart just recently in terms of gold and how gold has adjusted for inflation. And it is a lot closer to its 1980 high adjusted for official inflation numbers, where, as I say, silver is probably a quarter of that number still today.
Is the world thinking about silver in a different way?
So, yes, I do think that the world is thinking about silver in a different way. If we go back to early of 2024, I was saying at that point in time that we were heading for some kind of a squeeze. And the reason was because we had supply deficits. This year, we're forecast to have the fifth consecutive year of silver supply deficits. And for your listeners, just very simple, easy numbers. There's about 1 billion ounces a year of supply of silver. About 850 million ounces comes from mining, and about 150 million ounces, so 15%, comes from recycling. And yet we're consuming somewhere around 1.2 billion ounces. So we're consuming, on average, about 20% more than we are providing to market between, as I say, mining and recycling. So this silver has to come from somewhere. And early last year, it kind of struck me and I said, I've got to figure out where the silver is coming from, because in 4 years of ongoing deficits, why is the silver price not moving more? And the conclusion I came to from doing my research was that the big consumers, and I think especially the industrial consumer, they've been able to tap into what I call secondary supplies or above ground inventories of silver. If you look back a decade or more, whenever there is silver production that's not consumed, it gets sort of shunted into the futures markets and it sits there. And that had been the case for several years. And then about 5-6 years ago, we started to flip from surplus to deficit, and we've been in deficit ever since. So my conclusion was that these big industrial consumers were able to tap into these secondary inventories. They could simply, go to this market, so to speak, and say, I need 20 million ounces, I need 10 million ounces. And they were able to buy that and buy it at prevailing market prices that did not put pressure on miners or recyclers to bring additional metal to market. I saw that this had been going on for at that time, had been about 3 years. So from about 2021, you could see these inventories had peaked and were gradually being drawn down. And I said, this can only last for so long. And my forecast at the time was 12 to 18 months. And we've kind of seen it play out that way. Silver did bottom in late February of 2024, around $22, and then took off. And then we've really seen it run this year. And so that sort of 12 to 18 month period is what we've seen in the last sort of 6 months. And silver's really kind of gone crazy. And, certainly these tariffs by the US administration have exacerbated things. You had a lot of metal flew, by the way, because normally you'd ship it because it's so expensive. It's heavy and it's bulky. But to take advantage of arbitrage and to get some of this metal from London to New York, where there was this concern about there being potentially tariffs on metal being imported, a lot of metal left London earlier this year and found its way into New York. That left the London metals markets, where, by the way, a majority of these silver ETFs is held. That left them really squeezed and very, very, very tight supplies. And then this has kind of ramped up another notch in the last month or two. And these supplies were being drawn down even farther. And then we've seen all sorts of news reports about how really that market had gotten completely squeezed. We had, these technical terms, things like backwardation, which is what you have in the futures markets when the front contracts, in other words, the near-term deliveries or price of silver in those contracts is higher than farther out deliveries, which is not sort of the normal course of things. And you had lease rates explode. You had exchange for physical premiums explode. And we keep hearing how the market remains tight. India has become a big consumer. There are markets in China, markets in Dubai, markets in Egypt are just swamped with demand. Singapore is another example. Everybody wants silver right now, and there just isn't enough supply. So all of this has come together kind of like a perfect storm and pushed silver well beyond its all-time high. It went to $54 not that long ago. We've seen it. I've been calling for some kind of a correction for
Mm-hmm.
some time. I thought it would actually come sooner, but I'm frankly relieved. I think that that release valve needed to open. I believe it has now, and I view this as an opportunity. That's what I'm telling my subscribers. This has become a great opportunity to probably again deploy into some form of physical, and the mining stocks that are becoming more and more attractive.
Yeah, if the supply demand dynamics remain the same, there's more to go.
Oh yeah, absolutely. And even the Silver Institute themselves, who are the ones who are sort of the go-to for some of these statistics, are the ones who said that they expect a deficit again this year. So that would make 5 consecutive years, and they are forecasting deficits for at least the next 5 years, and new record
Mm-hmm.
high deficits to be set in these next 5 years. So, Ed, it's not getting better. It's getting the market's getting tighter. In other words, we saw silver supply from mining peak in 2016 at 900 million ounces. It's fallen over the last decade, yet demand has gone up by 20% or more. Recycling has been essentially flat over this time.
Mm-hmm.
And if you look at potential for new mined silver to come to market, it's essentially nowhere to be found. Discovery to production is a 10 to 15-year window. Discoveries have been few and far between. And then there's this whole thing that makes silver very particular, and that is that only about roughly 25% of silver comes from primary silver mining. That means that those mines produce primarily silver. 75% of silver comes from what we call byproduct, essentially. So 75% of mined silver comes from mining other metals, and silver is a byproduct. So we're talking about mining gold, copper, lead, and zinc. It's important, I think, for your listeners to understand that it doesn't operate on a typical economics 101 scenario. When you have these miners who produce some silver and it's a small part of the revenue stream, they're very happy to accept a higher silver price for the silver that they sell. But they're not especially motivated. They're not incentivized to even try to produce more silver because it's such
Mm-hmm.
a small portion of the revenue stream. And as you know, it's difficult to ramp up a mine. It takes time, takes capital, takes permitting, it takes all sorts of things. So for that reason, we say silver is supply inelastic. Even if its price rises and rises significantly, you typically do not see more or much more silver come to market to help meet that demand.
And let's talk about the demand a bit further, and then I want to go into your book a little bit as well, because you had some great points in there that I want to address. But I think that the misconception of demand is that it's investors coming into the market. But talk about some of the industrial demands that we're seeing in silver today that are virtually irreplaceable. At least in the modern world, we don't have anything coming online that could replace silver's role in sort of the industrial side of the ledger. Talk about what are some of the big industrial things that are driving silver today.
So I think your listeners have to grasp one big thing. The single biggest one has to be the solar panel industry. It has become the 800-pound gorilla in the silver space, and it consumes 20% of all the silver that's supplied every year. So that's just phenomenal. One single application consumes 20% of all the silver. Now, naturally, the manufacturers of solar panels, they do what they call thrifting. They try to squeeze out and minimize the amount of silver that they need, which makes sense, especially if you can manage the same output. That has been going on for a decade or more, and gradually we see it flattening now. So they've probably reached their limit in terms of thrifting. But technology changes. And so the more established the solar panel technology is, this is an acronym, but it's called PERC. And that has been very quickly replaced by a newer technology called TOPCon. Now, TOPCon uses up to 50% more silver per panel. So you'd ask yourself, well, why would you use a solar panel that requires that much more silver? Because it's going to be more expensive. And the bottom line is that although it consumes more silver, the additional, so it's more efficient really than the PERC
Okay.
type solar panels. And by being more efficient, you can justify the higher silver content and therefore justify consuming more silver to produce those panels. So it looks like the silver content for solar panels is actually going to start to trend upwards now. And we've seen that of all new production, I believe it was 2024, all new solar panel production had already shifted to over 60% of this new
Hmm.
technology called TOPCon. So that's absolutely going to be sort of the new wave of solar panel technology. It's ubiquitous in electronics because it is the best conductor of electricity, it's the best conductor of heat, it's the best reflector. And so you find it in very small quantities, by the way, too, in electronics in many ways. And so that can allow the price to rise without it affecting the price of the item that you're selling too much. I'm not going to say insignificant, but in many cases, the value of the silver in one product, let's say it's a smartphone or a tablet, something along those lines, it's very small. So price either gets absorbed or passed on.
So even if silver were to double, I mean, even if it were to double or more, it's not really going to change materially the cost of whatever it's getting put into. Or if it does,
That's
it's going to get passed right on to the consumer.
exactly,
Okay.
and it may not be that notable. We're certainly getting used to prices for everything going up considerably, and
Mm-hmm.
you wouldn't necessarily attribute it to the silver. You'd just say, well, like everything else, prices have gone up. Some of the other applications are pretty impressive. I mean, silver's what we call a biocide, so it kills bacteria, and the bacteria do not get used to the silver, so it remains consistently effective
Hmm.
against bacteria. So you find it in medical applications, in bandages, in creams. You find it in things like cornea replacements, so that you can avoid infection. You find it in water purification. You find it in things like nuclear fuel rods. You find it in oil refining applications. Silver is actually the commodity after oil that has the most variability, or the widest number of applications worldwide.
Hmm.
So second only to oil. It's really quite impressive. It's a bit of a what I call a wonder metal. And in many of those applications, it's difficult or impossible to replace. So it's really quite valuable that way.
There does seem to be this feeling of a reset happening in the market. We've gone from call it mid 20s from when you wrote the book, say, to breaking through 50, and now we're kind of getting in some settling down of the dust before potentially the next move forward. What will that look like, and what do you think will continue to drive that above and beyond just simply supply and demand?
I do want to address that part about supply and demand because I guess kind of the way that I look at it is that I see industrial demand because it's become such an important part of demand. Maybe 10 years ago it was 50%. Today we're at north of 60%. I think closer to 65% of demand comes from industry. Industrial demand is very, very steady and growing. Other than a recession, and even then, I have some thoughts about how silver can somewhat resist the potential for lower demand during recession to at least some extent. That demand is not going away. It's only going to increase. And so I like to say that industrial demand provides a rising floor under the silver price, and that it's investment demand that ebbs and flows and comes. And when it comes back in a strong way, it helps create these huge bursts of demand. And part of that, I think, is what took place over the last sort of month or two. And that's really what creates your potential spikes in the silver price. Yes, you can have these spikes, and yes, it can ebb and flow. But I believe that as the gold price continues to rise very significantly, people will look for an alternative. And when they see gold at $4,000, and then they see
Mm-hmm.
it at five, and higher and higher and higher from there, they're going to look for an alternative. They're going to feel like they may have missed the boat on the whole precious metal space, and silver is that natural alternative. Of course, it's much cheaper on a per unit basis, on a per ounce basis. So who knows, at 70, 80, 100, $150, silver might still look very cheap compared to gold
Mm-hmm.
and could help push it considerably higher even than that.
So it has this sort of double whammy of the supply demand as it relates to industrial applications and the consumption level going up, but also is potentially a replacement for or an addition to someone who's looking to allocate to other assets besides stocks and bonds like gold. Silver could kind of win two different ways, I guess is maybe a simple way to think of it.
Exactly. It's got both of those factors. It's the only metal that really has sort of this double personality. It's necessary for industry, and it's also a natural inflation hedge, although more volatile than gold. And it's been money for
Mm-hmm.
5,000 years. It's been money longer than gold has been. And it's considered by some to be responsible for an overall higher value of transactions historically because it was used so much in day-to-day transactions. Silver was part of our money almost continuously for those 5,000 years until the 1960s when it was removed from our coinage. So it has a very, very long history as money. Something interesting to keep in mind, Ed, is that recently in the US, silver was added to not the critical minerals list, but a list of metals and minerals that are to be considered for the critical minerals list. That's very interesting. If it does get added, who knows? Look out. Maybe there will be a strategic reserve. Maybe other countries will create strategic reserves of silver. And the US by itself imports 43% of all of the silver that it consumes. So I think that explains why we see a lot of these moves by the administration to start buying into public companies that produce or perhaps in some cases explore for strategic metals. We're starting to see them become a lot more proactive in terms of streamlining permitting and all of the steps to get mines into production. And that's not even necessarily just in the US. It can be with countries or companies who operate in countries that they consider friendly. And so they try to get involved and help facilitate and get these metals to market a lot more quickly.
Before we sign off, there's two last questions I do want to ask. One is any topic or point you would have hoped to have made today that I didn't give you the opportunity to make. And then number two will be how we can actually find you and gain access to your newsletter. So let's start with questions. Anything that you wanted to highlight that I didn't bring up?
Sure. Maybe the size of the silver market, the physical silver market is about a tenth the size of the gold market. The other thing to consider is that, when money starts to flow in this sector, it gets really hot really fast.
Mm-hmm.
And that just speaks to the potential. And if you look at The gold mining industry as a subsector, it's worth about $950 billion, publicly traded companies. If you look at the silver mining sector, it's only about $50 billion. So it's
Wow.
nearly 5% only of the gold mining sector. That was one point I wanted to make because it's such a small sector. When money starts to flow into it, it can just explode. And we saw that happen just in the last couple of months. To your second question, the best way to follow what I do is you can look me up at silverstockinvestor.com. You can see information about my newsletter there. You can subscribe. And if you go to thegoldadvisor.com and you look for the different newsletters that we have, that's where you can find my other newsletter called Silver Advisor. You can subscribe there for that. Other than that, I'm pretty active on X, formerly Twitter. You can find me on LinkedIn as well. And at the risk of sounding promotional, I really think that the book is a great way to get a handle on silver and the opportunity in silver. It really gives you, I think, a great overview, sort of start to finish, about the opportunity. And I continue to believe this really is a generational opportunity. So these are ways you can find out more and follow my work.
Well, Peter, this has been really great to meet you, first and foremost, but also to have you on Sprout Radio. Really, some great, insightful stuff. So, thanks for taking some time today.
Ed, it's been my pleasure, and I'd love to do this with you again.
Great, thank you. And once again, my name's Ed Coyne, and thank you for listening to Sprout Radio.
This podcast is provided for information purposes only from sources believed to be reliable. However, Sprout does not warrant its completeness or accuracy. Any opinions and estimates constitute our judgment as of the date of this material and are subject to change without notice. Past performance is not indicative of future results. This communication is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Any opinions and recommendations herein do not take into account individual client circumstances, objectives, or needs, and are not intended as recommendations of particular securities, financial instruments, or strategies. You must make your own independent decisions regarding any securities, financial instruments, or strategies mentioned or related to the information herein. This communication may not be redistributed or retransmitted in whole or in part or in any form or manner without the express written consent of Sprott. Any unauthorized use or disclosure is prohibited. Receipt and review of this information constitutes your agreement not to redistribute or retransmit the contents and information contained in this communication without first obtaining express permission from an authorized officer of Sprott.